The book delves into the importance of young people, particularly millennials, considering retirement planning. It highlights the potential challenges of relying solely on a state pension and encourages individuals to take control of their financial future by investing in the stock market. The review gives you insights on effective investment strategies, the potential growth of investments, and the importance of avoiding herd mentality in investing. Establishing financial security for the future involves initiating early investment in the stock market. Pondering your life 50 years ahead prompts considerations of financial comfort versus reliance on a meager pension, evoking anxiety with each expenditure. Given these two potential realities, achieving enduring financial stability becomes a clear objective. While some may view creating a savings account as the optimal method for securing their financial future, the reality is different. Savings accounts often feature interest rates lower than the inflation rate, causing money stored in them to depreciate in real purchasing power. So, if not savings accounts, what's the alternative? Investing in the stock market emerges as a viable solution, especially when commenced at an early age. The rewards of initiating investments early in life should not be underestimated, as the potential for capital growth is significantly heightened. Consider this scenario: an annual investment of $10,000 in the stock market, with a 7% annual return, accumulates to $4.7 million by age 65 for those who start at 22. In contrast, initiating the same investment at age 40 yields only $1 million. Despite the evident advantages of early investment, many millennials are hesitant, influenced in part by experiencing the 2008 financial crisis during their formative years. This crisis, the most severe since the Great Depression, has made millennials more risk-averse compared to their parents' generation. A 2014 risk survey revealed that only 28% of millennials' funds were invested in stocks, a notably lower figure compared to the 46% allocated by other generations. Millennials face an uncertain financial future due to escalating public debt and an aging population. The notion that one need not invest for the future, relying instead on a pension upon retirement, may be misguided given the evolving circumstances. The aging population in the United States has led to a surge in pension costs for the government. Consider the substantial increase in average life expectancy, rising from 47 in 1900 to 79 in 2013. Consequently, more individuals are surpassing retirement age than ever before, imposing higher costs on the government for pensions and health care. A notable example is Medicare spending, which has experienced an 11% annual growth since its establishment in 1966. This upward trend in costs is expected to persist, particularly with the onset of baby boomers, the massive post-World War II generation, entering retirement. The government faces challenges in sustaining these escalating health care and retirement expenses, raising doubts about its ability to provide retirement benefits to future generations. The government operates akin to a business. Maintaining balanced accounts is crucial to avoid bankruptcy. In practical terms, this implies that the government must collect enough in taxes to match the expenditure on benefits. Presently, this equilibrium is lacking, with a significant $9.6 trillion gap projected over the next 75 years between benefit spending and expected tax revenue. For millennials, this poses a substantial predicament. While they currently contribute taxes to support the elderly, there's uncertainty about receiving equivalent benefits during their retirement. Consequently, millennials may need to self-support without government assistance, emphasizing the importance of initiating early investments in the stock market. For those planning their long-term financial future, it's advisable to diversify investments across stock markets worldwide. Instead of concentrating all funds in a few companies within a single country, this strategy minimizes risks associated with the potential downturn of a specific national stock market. A compelling example of the perils of a single country focus is evident in Japan's stock market index, the Nikkei. In 1989, the Nikkei experienced rapid growth at 30%, enticing numerous investors. However, this apparent strength turned out to be a consequence of an unstable financial bubble that burst in 1991. Consequently, the portfolio value of a 1989 Nikkei investor plummeted by half by 2013. Despite the evident risks, individuals often concentrate investments due to the allure of stock market bubbles or a preference for familiar companies. For instance, in 2010, American investors allocated 72% of their funds to U.S. stocks, favoring well-known entities like Burger King and General Motors. To achieve successful investment outcomes, it is crucial to step out of the comfort zone and diversify across expansive, diverse markets. This approach safeguards investments against the collapse of a specific company or economy. Additionally, diversification can lead to increased returns, especially as global currencies fluctuate. Investing in companies like Samsung, based in South Korea, can yield gains when the South Korean won strengthens against the US dollar, resulting in an increased investment value. In essence, investing in stock market shares entails not only supporting a specific company but also involves an investment in the associated currency, emphasizing the importance of global diversification. For those seeking to maximize investment returns, it's advisable to diverge from mainstream strategies recommended by experts. The commonly advocated sector leaders strategy involves purchasing shares of the best-performing companies tracked by a specific market index, such as the Standard & Poor's 500, which includes the largest companies listed on the exchange. To implement the sector leaders strategy, individuals can invest in an index fund that consolidates stocks from the top 500 companies. While index funds are cost-effective and secure due to automated calculations, choosing to follow the herd may not lead to market-beating returns, particularly if the goal is to match the market index's performance. An additional factor to consider when contemplating alternatives to index funds is the tendency for the largest companies to underperform as they reach the pinnacle. Major corporations like Apple and Intel, for instance, commonly experience negative annual returns once their market value surpasses $400 billion, potentially making them less lucrative investment options. Contrarily, adopting the sector bargain strategy, which involves investing in the cheapest stocks rather than the best-performing ones, can lead to higher returns. Despite its counterintuitive nature, such approaches often outperform the leader strategy in the long run. For instance, since 1979, the Russell 3000, an index fund predominantly adhering to a bargain strategy, has outperformed the S&P 500 by over 1,100%. Your likes, comments, sharing, and subscriptions are a potent force propelling me to connect with thousands, if not millions, to share my message of self-development that has shaped my journey. Your support motivates me to consistently deliver high-quality book reviews. Now, let's seamlessly return to the review and continue this enriching journey together. For optimal investment outcomes, the recommended approach is to adopt a strategy that combines various effective selection criteria. This strategy, referred to as the millennial money strategy, emphasizes purchasing inexpensive stocks from valuable companies. The rationale behind this strategy lies in the potential for higher returns when acquiring cheaper stocks, as the investment is stretched further. However, it's crucial not to focus solely on the cheapest stocks available but to seek genuine bargains. When buying shares, it is essential to verify that the company possesses inherent value and that the currently low share price is likely to appreciate in the future. To assess a company's long-term prospects, examine its earnings and cash flow, as reported earnings may sometimes be derived from credit or loans. Evaluating the relationship between a company's stock price and its cash flow provides insights into its valuation. The goal is to identify companies with low share prices and solid financial positions. Enhance this strategy by incorporating momentum analysis, purchasing shares when the market recognizes a company's potential. One approach is to identify stocks with lower prices that have experienced significant price increases over the last 6 months, indicating positive momentum. An effective investment strategy involves a harmonious blend of value-seeking and momentum considerations. Further support for this approach is evident in the historical performance of companies meeting these criteria, as they have exhibited an annual growth rate twice that of overall market growth since 1972. Don't allow your instincts to dictate your investment decisions. Human beings are naturally prone to making investment errors. Our programming inclines us towards irrational fear. Scientifically, it has been demonstrated that we are susceptible to something known as constructive paranoia, characterized by an exaggerated sensitivity to loss. Consider a study conducted at Stanford where students were tasked with making 20 investment decisions. In each round, they had to decide whether to invest $1 based on a coin toss. If the coin landed heads, they lost $1, and if it landed tails, they gained $2.50. Surprisingly, after experiencing a loss, students were only willing to invest 41% of the time. However, from a rational standpoint, this decision did not make sense, as there was a 50% chance of winning a substantial reward. This inclination significantly impacts the market. Investors often buy at market peaks due to the fear of missing out and sell at market bottoms out of fear of substantial losses. Consequently, many individuals irrationally buy high and sell low, in stark contrast to the fundamental principle of stock trading. However, constructive paranoia isn't the sole investing mistake ingrained in our nature. Greediness is another inherent trait. Generally, people tend to pursue rewards even when the likelihood of attaining them is minimal. This inherent impulse contributes significantly to financial bubbles. Despite the substantial risk of a bubble bursting, individuals continue to invest because they are captivated by the prospect of future rewards. While instincts cannot be entirely eradicated, it is possible to separate them from your investments by implementing an automated system. For example, you can establish an automatic transfer from your bank account to your investment account. Determine the amount, frequency, and the fund you want to purchase with the money in advance. By doing so, you systematically apply a specific strategy without allowing instincts to interfere. Utilizing an automated payment system is an effective method to achieve this. It seems you've provided a substantial amount of content. If you have any specific requests, questions, or if there's anything else I can help you with regarding the provided information, feel free to let me know. Adopting a long-term perspective is crucial for profitable investment. Inexperienced investors often believe that selling their shares when they begin to lose value is the prudent approach. However, such short-term thinking is generally not profitable. The question arises, why do individuals succumb to this approach? The answer lies partly in our biology. Humans possess an emotional center, the limbic system in the brain, which drives decisions favoring instant gratification. This innate impulse is evident in investors who prefer buying bonds during financial crises. Since bonds exhibit less volatility than stocks in the short term, they provide a quick sense of gratification by shielding investors from confronting negative numbers. Consequently, investors feel that their wealth is safeguarded and preserved. Short-term thinking is not confined to individual investors. Even professional investors fall prey to it due to their limited career horizons. Professionals often formulate investment strategies with a 2- or 3-year horizon to showcase successful outcomes to current or prospective employers. However, analyzing data reveals that the most lucrative investments necessitate several decades, approximately 30 years, to reach maturity. The rationale behind this lies in the market's fluctuation, which predominantly occurs in short-term patterns. Despite the prevailing negative sentiments and anticipations of financial downturns, the market typically exhibits an upward trajectory over the long term. For instance, examining one-year periods indicates that stocks lose real value approximately 31% of the time, on average. However, stock indexes consistently generate positive returns over a 20-year period. In contrast, bonds tend to lose their value half of the time over the same 20-year span. If you have any more passages or text that you'd like to be paraphrased or summarized, or if you have any specific questions, feel free to let me know. The key message emphasizes the importance for millennials to initiate stock market investments early for securing their financial future. Long-term success in investing involves diversifying the portfolio globally. adhering to a chosen strategy, and making decisions that deviate from conventional trends. Actionable advice. Consider the tax implications of your investments. Holding your most profitable stocks for at least 1 year may lead to lower tax rates on gains, benefiting from long-term capital gains tax rates. In my life's journey, my mission is to impart profound value to my fellow human beings, and I take great pride in this purpose. Each day, I aim to cast a positive influence on someone's life as they begin their day. Luckily, your attention has brought us together on this platform, fueled by your keen desire for knowledge and wisdom. To expand our influence to thousands, if not millions, of knowledge enthusiasts like yourself, I sincerely seek your assistance. A simple gesture of liking, sharing, commenting, and subscribing to the channel can make a substantial impact. In return, I wholeheartedly pledge to provide impactful book reviews promptly. Your support holds immense significance to me, and I truly appreciate it. Thank you for embarking on this captivating journey with me.